right, now we're going to talk about transfer tax. Transfer tax is charged by New York State to the seller when real estate is sold. The tax is 0.65% if the sale is $3 million or above, and 0.4% if it's below $3 million. So that's pretty straightforward. Let's see if we can apply it in a question. A property sells for $400,000. What is the transfer tax? Because the sale price is less than $3 million, the rate is 0.4%. Now please note, the rate is not 4%, but 0.4%. That is 0.4%. So if you are converting it to a decimal, you have to be careful to put in the proper number of zeros. We take the sale price times the tax rate in percent, and we wind up with the transfer tax in dollars. $400,000 times 0.4% equals $1,600, which is the answer. And in our state, we also have recording tax. According to New York State Department of Taxation and Finance, the state, quote, imposes a tax on the privilege of recording a mortgage on real property located within the state, unquote. Mortgage recording tax is important because it is often a buyer's largest closing cost. Now, what we do to calculate this is we take the dollar amount of the mortgage times the percentage of the tax rate, and we get the dollar amount of the mortgage recording tax. That's pretty straightforward, right? Now, here's a question. Let's say Sam buys a home in New York City. I chose this because New York City is the most complicated. And the price of Sam's home is $1 million. Yes, New York is expensive. And the mortgage is $800,000. Mortgage recording tax rate is 1.925%. What is the mortgage recording tax? Well, the answer is, despite New York City having a complicated structure to their recording tax rate, the answer is simply to plug the numbers into this very simple equation. So you take the dollar amount of the mortgage times the tax rate percent, and you wind up with the mortgage recording tax dollar amount. $800,000 times 1.925% equals $15,400. Now, real property tax is extremely important. I think you're going to see a lot of questions on the licensing test about real property tax. And remember, we're not talking about income tax, which is based on our salary and how much money we make. We're talking about property tax that is associated with buildings that we own. Now, real property tax is levied by the local community, which would be a city, town, village, or county, and it's based on the dollar value of the real estate. In New York State, real estate is not taxed on the market value, but on assessed value, which is a fraction of the market value. And they're going to ask you questions about this on the test. Here's an example. The market value of Pam's house is $200,000. Her town uses an assessment rate of 60%. What is the assessed value of Pam's home? Well, it's pretty easy. Assessed value is simply a percent of market value. So we take the market value of Pam's home, which is $200,000, times the assessment rate, 60%, and we wind up with an assessed value of $180,000. Now, you gotta love the assessment rate, because wouldn't you rather pay tax on $180,000 than on $200,000? Of course. So the assessment rate is your friend. It's what winds up lowering your real property tax. Now here's the next question. Market value of Sam's house is $300,000. His town uses assessment rate of 40%. Tax rate is 6%. What is Sam's annual real estate tax on his home? Well, just multiply the factors together. $300,000 market value times 40% assessment rate times 6% tax rate is $7,200 annual tax for Sam. Now, please be a little bit careful, because sometimes the test may not ask about annual real estate tax, but quarterly, meaning 4 payments a year, or semi-annual, 2 payments a year. So you have to be careful to remember that when you're doing the calculations. And also, the test may ask about a whole town, not just one house. Question: if the assessed value of Pam's home is $130,000 and semi-annual tax is $800, what is tax per $100 of value? Answer: we know that Pam is taxed on the assessed value of her home, not the market value, so we don't need to know the market value to answer the question. We also know semi-annual means that Pam makes 2 payments per year. So her annual tax is $800 times 2 payments equals $1,600 annual tax. We also know that tax per $100 of value means per cent, because cent is Latin for 100. $130,000 assessed value times the tax rate, which we don't know, so we say blank percent tax rate, equals $1,600 annual tax. The tax rate equals $1,600 annual tax divided by $130,000 assessed value. Now you can see what I did here. I divided both sides of the equation on either side of the equal sign. I divided both sides by $130,000. And that's how I found out that the tax rate is actually 1.23%. Proration is the allocation or division of certain costs. At a closing, certain costs, such as tax or fuel, are divided between buyers and sellers. If a tenant takes occupancy in the middle of the month, they pay the prorated amount for the number of days they live in the apartment. Let's try one. A tenant signs a lease and takes occupancy May 27th. Rent is $1,000 per month. How much prorated rent does the tenant pay for the month of May? Now the answer is that in most prorations, all months have 30 days, called a banker's month. Divide the rent by 30 days to find out the price per day, and the tenant must pay for the number of days they live in the apartment. Partial days do count as a full day. The tenant lives there for 5 days, May 27, 28, 29, 30, and 31. So we take the $1,000 rent, divide by 30 days in a month, and we discover that the rent is $33.33 per day. We take that rent, multiply by 5 days, and we find that the prorated rent that is due is $166.65. Here's another proration question for you. Sam sells his house May 31st. He has already paid the entire year's real estate tax of $3,600 in advance. Under proration, who owes what to whom at the closing? The answer is Sam lives in the house 5 months, but is paid 12 months of tax. Therefore, the buyer owes Sam for tax on the 7 months the buyer will live in the house this year. First, find out how much the tax is per month, then charge the buyer for 7 months of tax. $3,600 tax divided by 12 months equals $300 tax per month. $300 tax per month times the 7 months that the buyer lives there equals $2,100. But who pays the $2,100, right? Well, it's $2,100 debit buyer, meaning they pay, credit seller, meaning they get paid. All right, we are no longer talking about real estate tax. We are now talking about income tax. Now, capital gains tax is federal income tax on sale profits. The rate of the tax is 15% or 20%, depending upon your tax bracket. If you sell your home, profits are not taxed if they are less than $250,000 if you're single or $500,000 if you're married. So let's try a question. A married couple sells their home for $400,000 profit. How much of their capital gains is taxable? Answer: 0. That's right, because if the couple are married, filing tax jointly, and they have lived in the house for 2 of the last 5 years, and capital gains are less than $500,000, then no tax. Next, Sam and Pam are married. They bought their home 20 years ago for $100,000. Sam dies. A month later, Pam gets a new boyfriend, of course, and sells the house for $650,000. How much are Pam's taxable capital gains? To answer this, you need to already know that Pam still gets the $500,000 marital tax exemption for 2 years after Sam dies. If you know this fact, the rest is easy. We take the $650,000 sale price minus the $100,000 purchase price and discover that Pam's capital gains are $550,000. $550,000 capital gains minus the $500,000 marital tax exemption that Pam still gets winds up with $50,000 taxable capital gains.